Okay, hopefully everybody can hear us well today. We're going to get started with the March 15th Director's Cut, and I'll set it to Lynn.
Thank you. May 15th, Director's Cut, March production though. So thank you everyone for tuning in or attending. It's great to be here. And in the midst of so much bad news, I think we have some good news, and that is that the month of March came in with only a 2% drop in crude oil production. So I think, when you go back and you look at the history, we can see that things didn't really begin to unravel until March 9th. That's when the Saudi Arabian OPEC disagreement or Saudi Arabia-Russia disagreement boiled over, and the announcement was made that they were going to dump crude oil on the market, and they started discounting Arabian light crude oil, which really kind of set off what we've observed through the month of April. But we went into March with pretty good production, 1.45 million a day, and averaged 1.428 or 1.43 million a day for March. So we started all of this from a good place. I wish I could say we had stayed there, but we did not. Natural gas production essentially flat, up 0.5%, which is intriguing, but that is more an artifact of how much and how rapidly things were changing during the month of March. And again, natural gas capture, we didn't quite get to the 88% goal. We landed 1% below that. And another artifact of the rapid changing environment the last half of March into April. And what I mean by that is the first batch of wells that were taken offline were low producers, high water producers that really didn't contribute much to natural gas production. That left us with wells that were flaring and wells that were connected. And the end result was that, the flaring didn't really correct until later in the shutdown process. Now, the second group of wells that began to be shut in, and that would have been in the first 2 weeks of April, were wells that were flaring most of their gas. And so we anticipate that April gas capture is going to look good. April crude oil production, quite the opposite. It will not look good. And so at least some good news, we ended the month of March and began the month of April with pretty good oil production numbers. Fort Berthold production followed basically the same track, although it was down 7%. And interestingly enough, as we look at today's drilling rig count, half of the rigs are operating on Fort Berthold. So that's extremely rare. That's again the rapidly changing dynamic and companies fleeing to the very best part of the core of the Bakken resource. Now, the resource hasn't gone anywhere, and the oil's in the ground, and the future potential is still there. It's a matter of when we might see that future potential arise. But you can see in our report what happened to crude oil prices, and it's, again, we were talking about any bit of good news we could talk about. West Texas Intermediate up about $2 today, so it's approaching $30 a barrel. That still is not a healthy oil price for North Dakota oil and gas production, but my field inspectors in the field yesterday and today, and we've been surveying again like we try to do at the end of the week and leading into next week, have indicated that they're seeing some wells go back on production. So we may have seen the bottom of this thing early this week is kind of the sign that this oil price, this WTI approaching $30 a barrel, is kind of supportive of producing wells. It is not supportive of drilling new wells or completing new wells, and you can see that in the rig count. We're at 12 rigs drilling oil and gas wells today. And that is a massive decline. So we were anticipating in early April that we'd see a 50 to 75% drop. It's actually down almost 80%. And the discussions around deploying capital and cash flow and that sort of thing indicate that there could be 4 or 5 more rigs released before we hit bottom in the rig count. So that would put us below 10. And we are likely to get to that spot. We kind of began all of this with 25 frac crews operating. And so we completed 120 wells in the month of March, which is a great number. It was above revenue forecast. So the March sales tax might be okay from that standpoint. But as of today, there's 1 frac crew left. So 24 frac crews idled and the crews furloughed, the people furloughed. So that's not a pretty picture at all. When you look at the crude oil markets, you can see that we're still in a major overhang situation as far as EIA numbers. Supply still well above demand, and that doesn't appear to be correcting itself until we get probably into the 4th quarter of this year. And when you look at the crude oil storage, we've never been at this level at this time of the year in history. So record crude oil storage. So I know that there's a lot of mixed signals out there. The price is signaling to operators, hey, maybe we should return some wells to production. But the storage is saying, you know, you're going to be able to fill this storage again very quickly, and that's going to send a major negative price signal. So we could see a lot of volatility over the next few weeks, especially since we know that the June crude oil contract expires next week. So will we see a repeat of the May contract expiration where we see a fabulous dive in terms of June contract prices? We'll have to wait and see. It's going to be the combination of that and the Brent price that's really going to tell us how the world production is responding to all of this storage that's out there. But there is so much oil in storage that it's going to really dampen any kind of rapid crude oil price response. We're going to see some volatility, but significant price uptick, major activity uptick. There's just so much crude oil in storage that's going to take months to work that off. It's enormous. I guess 2 last points to talk about, and then we can do some questions. Actually 3. So good news from PHMSA this week on 2 fronts. PHMSA decided to withdraw the rule proposal that was put out I think it was in 2015. The concept of maybe doing a vapor pressure rule. So that's been withdrawn. And then PHMSA did issue a preemption of the Washington law and rules that put a 9 psi vapor pressure on basically North Dakota crude oil being unloaded in the state of Washington. Now, before we celebrate too much, it's possible that the state of Washington could request a reconsideration. They have 20 days to do that, and it hasn't appeared in the Federal Register yet. So they've got 20 days once it appears in the Federal Register, and they also have 60 days after it appears in the Federal Register to appeal that to U.S. Court of Appeals. So, you know, great news, but it ain't over till it's over. And so there could be continuing ongoing issues there. I want to talk a little bit about the Bakken Restart Task Force. I'll close with that. There will be new information posted on that today, and the task force will be meeting again after next Tuesday's hearing. As you know, Tuesday we're going to have a hearing on whether we're in a situation in North Dakota that would constitute waste, which could, if the commission made that decision could lead to the Industrial Commission intervening in terms of production and contracts and all of those kind of matters. Comments been pouring in. Written comments are due by 5 o'clock today, I believe, and then testimony will be taken on Tuesday. So far, and I've just very quickly run through the comments, we have comments from mineral owners, from tribal members, and from oil and gas operators. I only found one that was even approximated being neutral. All others were strongly opposed, and so we'll see how that all shakes out on Tuesday. Maybe we'll hear from the folks that support a waste decision on Tuesday. But the task force will meet again following that. I think the major news to come out of the work of the task force is budget section approval this morning of a little over $33 million to confiscate abandoned wells and put out contracts for our workover and cementing and roustabout companies to go out and plug somewhere between 400 and 550 wells. We're doing, we don't know the final number until we hold our hearing and we find out from operators, are they strongly opposed to their abandoned wells being confiscated? And secondly, are they going to take care of them? If they're opposed to them being taken care of with CARES Act funds, then how do they propose that the wells be taken care of? But we're excited about that work because it has the potential to keep 500 people in the oil and gas service sector working for the next 6 months until those funds have to be expended. So great jobs program, and it will keep employed a core group of highly skilled workover rig and cementing and consulting people who will be key to returning wells to production when we see the price signal that says, yeah, we should put wells back on production. Over the last week or so, we've seen additional wells shut in and additional production shut in to the point where we're pretty solidly convinced that we're below 1 million barrels a day as of today. We think we're somewhere in that 950 range in terms of production today, and somewhere north of 7,000 wells shut in. And so seeing some of those go on and off, it's pretty hard to discern exactly how many wells are shut in. We can't do that. We can only estimate based on talking to pumpers and field inspection work that they do out there. But, that's all the current news. I guess we'll just close with the fact that the task force is very active and doing a lot of planning and talking about how we can sustain oil and gas service sector employment, and then how can we incentivize companies when the price is right to put North Dakota producers back on, before our competitors start putting their oil production back on. So with that, we'll take some questions.
The approximate number of wells, 16,000?
Yeah, about 16,200. The question was approximate number of wells producing. And so, yeah, we went into the crash. We ended the month of March. Let me just look here. 16,263. Yeah.
And you're down 7,000.
Correct. Down about 7,000.
I have a question kind of related to hearing next week. So I was out not working since the week that this was all sort of talked about and never quite caught up to it. But when oil is sold at a loss, and if it were to be classified then as waste, I think that has certain implications for like leases and permits. Can you explain that?
Sure. So the question was, what are some of the implications of classifying oil being sold below market price, I guess, or market price being below production and post-production costs? So oil is sold at a loss and defining that as waste. So the effect of a government decision like that is it appears in virtually every oil and gas lease statewide. If you look at the standard producer 88, that's what they call it. Every industry, I guess, has its lingo. If you read a producer 88, you will find that a government regulatory decision is considered force majeure. It's the equivalent of an act of God, in terms of like a hurricane or an earthquake, something like that. And so the effect would be to nullify any cessation of production clause or required drilling activity that was part of an oil and gas lease. It would also potentially spill over into firm commitments for firm transportation capacity or firm processing capacity. So let's say that an operator had signed up on a take-or-pay contract, and they were required to deliver X number of barrels every day and pay for that, whether they put the barrels in the pipe or the gas in the pipe or not. It would also allow a force majeure on those kind of contract terms. So we put out quite a long list of information that we wanted to get from this hearing. And so we want to know, I mean, we're aware of those consequences, but we want to know about any other potential consequences that could interfere. North Dakota has not taken this kind of action since 1965. So as I told the commission, Industrial Commission Order Number 1 was the adoption of administrative rules for oil and gas regulation. Industrial Commission Order Number 2 was a waste and proration order. So that happened in 1952. At the time, the demand for North Dakota crude oil was 14,700 barrels a day. And when it ended in 1965, it was 81,000 barrels a day. And it ended because the Mandan Refinery came online, was fully online, and was capable of processing all of the oil and gas that wasn't leaving the state by rail car. So it was in place for about a dozen years, and everything has changed since then. There was no such thing as WTI crude oil price. There were no interstate crude oil pipelines or interstate oil gas pipelines leaving the state, and so there were two places for crude oil to go at that time. You either had a contract with the Mandan Refinery or you shipped it out by rail to a refinery someplace else. And so there were no take-or-pay contracts. The only wells were on the Nessananic line, north and south of the Missouri River. And so the world has changed a lot since the Industrial Commission did proration and waste. And so we'll try to sift through all that on Tuesday.
And is this concept of waste, does that always go hand in hand with proration, or can you classify it as a waste without actually prorating?
That's a really good question, Amy. So the question was, does the concept of waste always go with proration, or could you classify it? And the answer would be yes. We could classify production at those price levels as waste without the follow-up action of proration. However, statutorily, we are required to prevent waste. So if it was determined that producers were not shutting in their wells to prevent waste, then it would lead to proration. So it's a very short step from point A to point B, but it is possible to classify it as waste without taking the next step and actually prorating production.
Any additional questions for Lynn?
Oh, yeah, sorry, a couple more.
Oh, yeah.
Okay, let's see. So your current rig count, you said, there's 12 rigs currently drilling for oil in North Dakota. I know in the last record cut you went over some of this, but do you know maybe the last year or the last time period when the rig count was that low? And I'm wondering if it was maybe because the shale business starting up in the late.
Yeah, I can, so the question was the last time that we were at 12 or even, below 10 drilling rigs in North Dakota. And we can get you an exact date, but we've not been there since the Bakken play began. So, this all kicked off in 2006, and we were above that number even then. So, off the top of my head, the only other time we've been at this point is during the 1999 price collapse. And, that started in 1998 and it ran through about 2001. So it's about a 2 or 3 year price collapse. And we did actually get to 0 rigs at that point, but we can get you a more exact number on that, but not since the Bakken play began have we been here.
And then I noticed that right now, and then a couple weeks ago too, so there's some rigs that are drilling to the carbon capture and storage project. And is there anything special or different about the way that those rigs go about drilling these wells, or is it relatively similar to drilling an oil well, but just not as deep and horizontal?
Yeah, good question. So what about the carbon storage drilling process and how is it different? It is quite different. The wells are all vertical, so no horizontal drilling involved there. The rules are significantly more stringent about how the wells are completed or constructed, and the information that has to be collected. So in the typical horizontal well, you rarely see people cut core anymore, or collect core and put it in the core library. In terms of the carbon capture and storage, they have to core the interval above the storage zone, through the storage zone, and below the storage zone. So, for example, the Richardson well, they spent about 2 weeks cutting core, and they use a different drilling mud system. The information that we're required to collect for those kind of wells requires a different drilling mud system, and so they typically use a water base as opposed to an oil-based mud. The process of putting a bit in the bottom of the hole and grinding the rock up is the same, but much more coring, lots more log information collected, a different mud system, and always vertical wells. So some substantial differences.
Got it. And then both the Project Tundra and then at the ethanol plant Richardson, both of those projects will have to then, they've already received some initial permits from the Industrial Commission, but then they're going to have to go back and receive another additional permit, or maybe it's even a couple of permits. Am I correct about that?
Yeah, you're correct. So all they've gotten, so far, they've gotten geophysical permits, so they could do their seismic analysis of the storage zones, and they've gotten stratigraphic well permits, which allowed them to collect all this rock and build a well and collect all this information. They are going to have to get a storage facility permit. And before they do that, they have to secure the pore space rights for permanent storage of carbon dioxide. And they'll have to come to a hearing to get those permits. No hearing like that has been held in the United States yet. So the previous projects were all permitted through EPA, and they were done, with a lot of paper passing back and forth at an EPA region office. So it'll be the first one in the United States. And then following that, they'll need permits to actually use well bores for the injection. So they'll have to permit the well specifically, the well or wells specifically themselves. So they've got a good ways to go.
Lynn, I have a question on mine. If we've hit a bottom of production curtailment, how rapidly could it ramp back up again, and what does that look like? How cautious would operators be in light of such volatility?
Yeah, good question. So, having the wells having not been shut in for a very long time, they might be able to come on pretty quickly. However, the storage numbers that we see from EIA and the price signal that we're going to get next week, I believe is going to say we really shouldn't be returning a significant volume of production till the fourth quarter of this year, maybe even the first quarter of next year. And under those circumstances, you now have had wells shut in for 5 or 6 months, and it's winter time in North Dakota. So the ramp up will be much slower than most of us would like to see. If suddenly, someone could wave a magic wand and all this crude oil that was in storage disappeared, I think it could happen pretty quickly. But I think it's going to take 6 months or a year based on the anticipated time between now and when it really actually starts.
If I may follow up on that, what kind of role would the market for even having the labor for that ramp up play in that?
Great question. So the question was, what about having the labor available to even make that happen? And that is going to be a serious issue. It's one of the reasons that we wanted to talk to the Emergency Commission and the budget section today, is that at least the core labor, the workover rig companies are going to be there. But the ability to finance that is going to be a real stretch. So let's talk about two things. One is the labor force. The labor force will largely have left the industry, and unless North Dakota gets a jump on other shale plays in terms of restart, people will likely not be in North Dakota anymore. And it'll be difficult to incentivize them to return in the wintertime to put wells back on production. Secondly, we know that it's typically going to cost $25,000 to $50,000 per well. If these wells are idled for 4, 5, 6 months, then there are going to be salt problems and artificial lift problems, and so they're going to require a workover rig to put them back on, and there's going to be a limited supply of dollars, rigs, and personnel to make that happen. So I think it's going to be a rather slow process to get production back online.
A question online. North Dakota shut in about a third of its production. Have any other U.S. oil plays reduced its production by similar amounts, or where do we land in that?
Yeah, good question. And the other states don't keep very good numbers, so so it's hard to answer. I did have an extended conversation with Alberta's energy minister just a few days ago, and they're actually more like a 40-45% production reduction. And Oklahoma indicates that they're maybe close to where we are in Texas, but they have most of their production is reported on a lease basis, and it isn't many of those states. It isn't reported even on a monthly basis. So it's really hard to say. We think that Texas, Oklahoma, North Dakota are pretty much in sync with one another, and Alberta has significantly more production shut in than we do. And they've got a good firm number.
In your discussions with the companies going through this rough time, are they getting a little so-so about the Bakken, or are they still pretty confident in the Bakken?
Yeah, question was, are the companies feeling nervous about the Bakken, or are they still very confident? And so I have not talked to a single company that is looking to liquidate their Bakken position. Some of them are scared they might be forced into that situation if this goes on too long, but not one company has said, wow, here's an opportunity to get out. And so no, they love the resource, and they like working in North Dakota, and they'll stay if they possibly can.
You talked a little bit earlier about the mixed signals of the storage being so high, but yet people want to get back to production. What are the possible solutions there? Is the Bakken restart a solution for people who may need a job in this time where the labor market is not where it needs to be?
Yeah, thanks. So what are some of the possible solutions to this dilemma that we have about, holding off on putting wells on because of the storage and not causing another dip in price, which I think is the real concern, is that could happen. So some of the things that we've been discussing and we've been talking to our congressional delegation about, is there a possibility in another round of stimulus for money not to be given to oil companies, but to be loaned to oil companies, which would have to be paid back? Or is there something we might be able to do through the Bank of North Dakota along those lines? If the legislature was so inclined, and it's going to be a tough budget coming into this next session, but they could possibly offer some tax relief to back that up. But that's what's being investigated is there an avenue to use federal money or to use assets that are in the Bank of North Dakota to offer low interest loans to oil companies to basically hire people and get them ready to put wells back on production. One other thing that's being investigated, is probably a lower probability, but the trust funds that North Dakota has, and I think we got in excess of $10 billion sitting in trust funds, they do have the option of investing. Now they have to meet some pretty stringent investment requirements. I mean, they're very stringent, but there is the option there that's being looked at. And again, I want to say it's not highly likely, but it is a possibility that some of that trust fund money could be invested in the form of a wellbore overriding royalty interest or something like that, in order to employ people and return wells to production. So yeah, there's a lot of brainstorming going on.
I have one more labor question related to that. With a lot of people in the Bakken who have made it their main place to live because it's surrounding the oil industry, what can they do in the meantime, and is the Bakken reset program something that can help those workers in the future?
Mm-hmm. Yeah, so I'll start with the last one first, and yes, absolutely. I mean, the Bakken Restart program is all about encouraging those people to stay in North Dakota because we know the companies want to stay here. We know that they ultimately want to put these wells back on production. They ultimately want to drill, another 30,000 wells in the state, and so we're trying as an industry and through the task force to figure out ways to allow those people significant unemployment while they're furloughed, but to get them back in a working situation as quickly as possible. We're investigating some other alternatives. So, for example, one of the big concerns about the oil and gas industry nationwide is methane emissions. There are some significant things that could be done to reduce methane emissions, and this is almost a perfect time to do that. So we're actually investigating a program where 37,000 thief hatches on oil storage tanks around the state could be replaced. That would put a lot of people to work for a long time. It takes 2 days to replace one of those things, and so there's some new technology out there that didn't exist when these storage tanks were originally built. It is the #1 methane leak that we see in the oil and gas industry. And so we're not looking to give operators a free ride, but we're thinking, could we do some kind of grant where maybe CARES Act money is used to pay for the thief hatch and they pay for putting it on? And so, yeah, lots of ideas like that where, additional groups of 300 and 400 and 500 people can be kept employed.
Is that Department of Environmental Quality that would potentially be a program like that, or would that be oil and gas?
Good question, and it would be the DEQ that would be leading a program like that. And so those funds likely would flow, unless CARES Act money could be used, we'd be looking at some funding to flow through EPA and the DEQ in order to do a program like that. But we could come out of it with a much cleaner and greener oil and gas industry.
Got one other question for you. Could you just give us a real brief summary of the sort of work involved in both shutting in a well and then restarting a well?
Mm-hmm. Great. So the question was, what kind of work is involved in shutting in a well? And so, normally wells get shut in because they're low producers, and it isn't much more than turning off the switch and tightening up the stuffing box so that the wellhead doesn't leak, and then figuring out how often the pumper is going to go by and check on it, putting seals on the tanks. But we're talking here about high volume, high gas wells with expensive artificial lift systems in them. So in many cases, the wellhead actually has to, that valve system at the top of the well has to be taken off and replaced with a high pressure wellhead. At a minimum, the area around what's called the polished rod, that real shiny one that you see going up and down out of the top of the well, that's called the polished rod. That has to be sealed off, and there is a thing called a blowout preventer or a frac protect piece of equipment that can be installed there to protect that. Our produced water is nearly saturated with salt, so a hot oil truck or some type of truck needs to be hooked up to the casing on the well, and fresh water has to be pumped into the well to make sure that it doesn't seize up with salt. And then also you need to have water in the well so that the frac sand doesn't, when the well is shut in, the fractures can open and the sand will fall out into the well bore. And then when you put the well back on, the sand that stayed in there can be crushed. So it's a pretty extensive process to shut one of these wells in. When it comes time to put it back on production, then normally it's going to require a workover rig. That polish rod, blowout preventer, or frac protector is going to have to come off. More than likely, the pump is going to be stuck, either the submersible pump or the rod pump, and so it's going to have to be pulled and repaired or replaced. And then the well's going to have to be circulated with water to get it ready to produce. And then you got to have a flowback crew come out there who specialize in controlling and flowing high rate wells when they're put on production. So we're talking about crews of 15 to 25 people involved in getting a well ready to shut it in and bringing the well back on production.
All right.
Thank you.
Everything on your side? Give this a second here. So while this is queued up behind me, Justin Kringstad, Director of the North Dakota Pipeline Authority. We're going to get right into some of the neighboring production. You heard from Lynn about North Dakota. It'll be very, very interesting in the coming months what we see happening in eastern Montana as well as South Dakota. We fully understand what's going on in North Dakota and the differing profiles of production and how that impacts decisions to shut in production or keep it online. And so these neighboring states that have a different set of historic production, some of the early Bakken Three Forks production on the eastern Montana side. I am expecting some pretty substantial shut-ins from those neighboring states. What it looks like on a percentage basis, we'll see. But certainly along with North Dakota's shut-in and decreasing production, that'll all get wrapped up into how the transportation dynamics look here in the near term. So again, just for context, looking at that February to March month-to-month change, oil and gas, not the dramatic shifts that we're expecting here in the next couple months. So for right now, we're, again, as Lynn alluded to, we're right at the beginning of the downturn. From a transportation side, again, with production fairly steady from North Dakota and expected to be fairly steady, at least in March, from our neighboring states, we didn't see a major shift. We saw some transition, more barrels getting onto the pipeline network, and that had, I believe, more to do with some of the pricing dynamics that I'll touch on here in just a moment. You'll notice the blue dotted line, that's the Brent WTI spread. In the month of March, we saw a significant decrease down into the very low single digits. That's been in flux over the last 8 weeks or so. As we get into April and May, I think the transportation dynamics will get very interesting. I don't have any hints yet as to what it might look like, but we know that with storage filling up, we saw different pricing scenarios that we haven't really experienced before in recent times. All of those being wrapped up into the way that barrels are being marketed out of North Dakota. So stay tuned. The April, May numbers and forward through the summer should look very interesting. And then crude by rail, not a major shift when we look at all in the barrels getting on the rail cars. Destination, at least for February, this was again pre-downturn. That's the latest we have available from the EIA. Pad 1, the East Coast, and Pad 5 on the West Coast sharing the market. One interesting trend way down at the very bottom. It's been quite a while since we've seen any barrels delivered up into Canada by rail car out of North Dakota. The EIA was reporting a very small amount of North Dakota crude oil going into Canada in the month of February. So I don't know if that will start any type of trend or if that was just a one-off marketing decision, but we'll keep an eye on that as well. And then pricing, at least for the month of February, East and West Coast, Pad 1, Pad 5, highest price markets. So again, when we see where those barrels are being marketed, if they can get there on a rail car and make it cost efficient, then they will do so. You look at the Gulf, Pad 3 being the third highest, but we do have a lower cost mode of transportation to get to the Gulf Coast. So all of that balancing out is, at least in the month of February, one of the prime destinations. Again, as we get into April and May, we'll talk in the coming months about how some of these things shifted around. And then where things sit today, after a widening Brent WTI spread in recent weeks, it's been narrowing again, now less than $3. The Gulf Coast is back to a premium. There was a period of time, I believe it was last month when I was updating these slides, that LLS pricing at the Gulf was at a negative $3+ in the month of April. So April was a very tough month pricing-wise in North Dakota. We saw very, very steep discounts for crude oil, coupled on top of very, very low base benchmark pricing. So April was a very, very tough pricing month for production in North Dakota. That discount has narrowed. Things have improved on that front. Some of the more market trends have normalized, such as having higher pricing at the Gulf. That helps with barrels getting marketed on Dakota Access. The Clearbrook pricing has been fairly strong for barrels that are going out on Enbridge to the east. So again, things have gotten much, much better so far in the month of May. And we did see decreasing amount of traffic in March going both north and south across our border port. When we talk about some of the dynamics just north of the border in Saskatchewan, there is a fairly large rail facility that handles not only ag products but energy products as well at Northgate. And so we're seeing some of the decrease in exports. I believe that because of the price dynamics, that low Brent WTI spread in the month of March, maybe we saw less truck traffic going north to get onto that rail facility. That would make sense from kind of the way all the numbers were going, with more barrels getting on pipeline, little bit less getting on rail car for the month of March. Shifting gears to natural gas, same holistic number, 87% capture. We saw just a 1% shuffle between the blue and the orange pieces of the pie graph here. We did see a higher number of wells get connected to gas gathering systems in the month of March. That helped narrow that blue piece. It went from 5 to 4% from February to March. And again, that downward trend continues. And as Lynn mentioned, I think we'll hopefully see some very positive numbers, at least from a gas capture percentage. The gas captured volumes will be down, but from a percentage basis, things should be improving here, at least in the near term. And this was that graphic I just mentioned a moment ago. It's always good when the black line is above the red, meaning more wells are getting connected to gas gathering than new wells producing gas. So that helped narrow that piece of the pie. And then in a moment, I'll show you, this is just came out this week. This is the EIA's most recent short-term coupled with their long-term oil price forecast. So they do see some strengthening. Last month when I showed this graphic, they were at $20 for several months. They've since raised that expectation. And so this is what I use for my crude oil and natural gas production modeling. You'll see the natural gas model here. It looks a little bit strange again, because we see where we're at, that black line, and then a very, very noticeable decrease from two things happening. Wells being shut in, and then a very low to minimal amount of well completion. So those two things on top of each other lead to very, very rapid decreases in production. But as we see production come back online, those shut-in wells, that gas volume starting to increase. And then as we get to price point triggers that start moving operators into a position to complete more wells, we get back on that growth trajectory. So again, long-term natural gas, crude oil, both look very robust with the price decks that are out there from the EIA. And with what we know about the resource in the ground, Lynn mentioned it very correctly, that the resource certainly hasn't gone anywhere. It's just it's a pricing scenario. Once prices get to that economic threshold, we will see operators go back to completing wells, bringing wells back online, and getting this region then back again on a growth curve. So I won't touch a whole lot on some of the natural gas dynamics that are going on. Northern Border has been a topic of discussion for quite some time. Just recently here at the beginning of May, they did file with FERC to put a formal 1,100 BTU limit on their system exit Glenolan, North Dakota. And so we've been seeing some of the FERC filings here just in the last several days coming in from interested parties, both for and opposing that tariff change. Some of the more recent trends on Northern Border, we've seen North Dakota's volumes decrease, we've seen Canadian volumes decrease, and so all in, Northern Border, at least today, is running relatively cool in that 1080, 1090 BTU range. So we're not quite at that ceiling yet. If Northern Border does get approval for that 1,100, their original date in their filing on May 1st was to have that in service new tariff June 1st. Regardless if FERC approves the June 1st, I see it becoming a challenge for some gas plants in North Dakota to start meeting it more likely about a year from now as we kind of get out of this downturn and we start back on that growth path forward. So some of the immediate impacts of that tariff change, if approved, would likely be seen next year as opposed to in the more immediate term. So with that, I'd be glad to answer any questions.
I have one about what you were just talking about with Northern Border. If that lower limit is enacted, how easy is it for a gas processing plant to maybe make some changes to that?
Yep.
And is that even an option?
Yep. So the question was what position are the various gas plants in order to meet that 1,100 threshold? And so it's a mixture. We have some facilities that are in a very good position. They have the plant configuration. They've got exit options on pipeline to move. Ethane is the primary molecule that folks will have to shuffle around in order to meet that 1,100. There are some plants that will not be able to. The plant configuration and design simply cannot get to that level. And so one thing that was put into that tariff filing was what's known as pairing. And so it would be a commercial arrangement between a plant that could not meet that 1100 limit, would have to pair their gas with someone that could, and blend it between those two facilities to get to a normalized 1100 level. So that's the proposal right now. There's still a number of questions out there being raised by industry about how that would all come together and the timing of it, but hopefully those questions get answered and we at least have a decision one way or the other relatively soon.
Is there actually retrofitting that facility to do to make machines to get there?
There's some things. So the question was, can a plant do any type of retrofitting? It's a little bit challenging. The base configuration of a plant, typically if it's a refrigeration-based plant or if it's a cryogenic-based plant, that will drive whether or not they can get the ethane out of the gas stream. There's folks looking at whether or not they can take that rich stream and divert that to a different facility. Can they use that for power generation? What can be done? Can it be re-injected for enhanced oil recovery, storage? All kinds of things right now are on the table for solutions.
Any additional questions, Jeff?
Yeah, what is the current, do you know what the current price point is for MCF and organic gas?
So the question was the pricing for natural gas. There is no public pricing for the Williston Basin. The nearest that you'd have to get to is Ventura, ACO up in the Alberta. Those are typically, if someone's curious about North Dakota's pricing, I typically look at ACO up in Alberta, look at Ventura down in the Midwest, and start to get a sense. But there is no publicly available data set that I'm aware of.
And given the charts, you kind of agree with when the fourth quarter of this year or maybe first quarter of 2021 before we start seeing.
Before we start getting back on a real, the way it's currently forecasted, the deepest shut-ins, at least in the model that I put out, were in this May-June type time frame, and then starting to slowly come off as we move into the third and fourth quarter, and starting to get back in 2021 to shut-ins are done and starting to get back on a more regular trajectory.
With all the volatility that we saw during the month of April, do you anticipate that the percentages of oil that's taken out of state on pipelines versus rail, do you anticipate that changing much at all, or is that just like way too hard to determine who that happens?
Yeah, right now, so the question was, do I have any guesses about the kind of April, May timeframe? And I really don't, because there were so many things that were surprising a lot of those folks in the industry about where crude oil prices were still relatively strong, where crude oil prices were really depressed, and things were just not normal from a pricing perspective. So it'd be really hard to look at historic trends and anticipate what April, May ultimately looked like. Okay, well, thank you very much.